Everyone, and welcome back to the Petroleum Economist 2020 LNG to Power Forum. When Sharif Souki made his first application to export LNG from Sabine Pass in August 2010, he took a lot of people by surprise. Looking back, he set off a stampede, which has led to the US becoming one of the world's largest LNG producers. But it wasn't just about volume. The commercial models adopted by the first wave of projects have changed the way LNG business is done forever. And as I said in my opening remarks earlier today, the US now appears to be becoming a swing supplier and changing the market dynamics of the global LNG business. The second wave projects have been struggling to reach final investment decision. And again, there has been a lot of commercial innovation. In this session, we pose the question, which commercial models are best placed to succeed in North American LNG export? Our moderator for this session is Caryn Fuller, who is Director of HKA. Caryn, over to you.
Thank you, Alex. Good afternoon and welcome everyone to our panel discussion. My name is Caryn Fuller. I'm a director with HKA, and I'll be moderating today's panel discussion. First, I'd like to start off by thanking the Petroleum Economist for inviting me to be a part of such a fantastic event. We have a great panel of subject matter experts lined up today. We have Julie Mayo, who is a partner in the Transaction Practice Group, and who is the head of oil and gas at Norton. We have Jason, who is the global head of business intelligence with Poten and Partners. And then we have Tim Swenk, who's an advisor with Endeavor Management. So our panel will be structured for topics today. We'll start off by reflecting on past North American LNG projects. We will then discuss new risks and commercial challenges, followed by discussing commercial operational disputes, and then with improving commoditization. So we'll try to address questions as they are received, but you're more to reach out to us after the program. So now let's start with our first topic, which is on the reflection on past North American LNG projects. So reflecting back on some of the North American LNG projects that were most recently completed prior to the COVID-19 pandemic, what business models and key project execution methods impacted FID and project viability? What are some weaknesses that were observed that impacted enhanced project viability? Jason, would you like to start?
Sure. Thanks very much for the question, Caryn. Also, thanks to the Petroleum Economist for holding this and for the invitation to speak today. I think one of the, obviously when the U.S. First wave got started, as you mentioned, Sharif Souki and at the time with Cheniere, of course, you had this very, this sustained spike in prices, global LNG prices. You'd had the Fukushima nuclear accident that had sort of increased demand from Japan quite substantially. So you had these prices, $12, $14, $15, $16 a million BTUs. And the US was sort of offering, $8 or $9 delivered into Asia. And that seemed like a great opportunity at the time as gas production was rising in the United States because of the advent of shale technology. And so we've learned quite a bit over the past few years. I think the first thing we've learned is that those first contracts are relatively expensive. We've got sort of $7 winter LNG prices. And it's difficult, with a $3.50 liquefaction fee and $3 US gas, $2.75 US gas, to sort of get that to be profitable into Asia. It is right now, the arb is open. But I think one of the things that US project developers are really having to focus on now is really getting their costs down, being able to deliver LNG cheaper. So you see there've been a couple of projects, Venture Global's Calcasieu Pass, for example, was offering sort of sub $2 for some of their clients. So I think, that's really the critical thing. All the US projects, most of the US projects, I should say, are going to have to be project financed, which means they're going to have to pre-sell most of their volume. And that means that they're going to have to convince off-takers that they're highly competitive, that they can compete in a world of $6, $7 LNG. So I think that's the real challenge, and that's what's really driving innovation in the United States these days.
Excellent. Thank you, Jason. Tim, would you like to add on to what Jason said?
Yeah, maybe just a thank you again to the petroleum economists, and glad to be part of this panel representing Endeavor Management, advising management consulting group based out of Houston, the oil and gas business. So I'll probably bring a perspective in addition to Jason and Julie that's more around the asset development and execution of delivering that asset before it can monetize the LNG. So just for context, if you look at different studies and study these projects, about 30 to 50% of the running cost of LNG is related to the capital cost or CapEx. And we know that percentage may vary depending upon location, kind of the relative cost of the feedstock in the area and the existing infrastructure that these LNG export terminals start with. Probably realize many of these terminals have started out as import terminals and turn them around. So hence possibly a little lower percentage of total cost related to the asset. But, the history lesson says most of these capital projects are large train projects, 2 to 3 trains per site, with the bigger is better, economies of scale approach. My observation, though, in the past here is that these projects are very stressed by complexity factors, and there may be new complexity factors that we hadn't seen a decade ago, such as contract size. There's some unfriendly JV structures are required to share some of these more difficult commercial terms. A lot of times aggressive cost and schedule targets are assumed and bought into by the EPCs on behalf of obtaining the work for the developers. There's a lot of overlapping in the different phases of the execution of delivering these assets, from design, procurement, construction, and startup, again, which contributes to complexity and risk. We've seen craft labor availability, especially on the Gulf Coast U.S., and its reliability being questioned, and something that is not predictable. And of course, Mother Nature has factored into things, and now, the COVID restrictions and regulations. So just some of the things that make things harder for those that are normally contracted to deliver some of these reliably and maybe cost effectively. So what are the impacts of some of those? Again, in the past, we've seen owners come to, quote, bail out some of the EPC on certain contract terms midway through or near the end of some of the build cycles. These contractors may become distressed in their own right, sometimes during the course of the build, which again creates issues and for future projects limits the competition. Delayed and unreliable startups. I think we've seen that in most cases on these large train projects. Again, I think there's a mitigation to that. And then, during operation, sometimes the reliability of the operations in the way of unplanned startups and early shutdowns, again, limit the efficiency of these facilities to deliver predictable cost and maybe lower cost LNG. But the bottom line, as I see again from the asset developer side, is unpredictable asset CapEx and early life cycle OpEx costs that mitigations need to be considered when you're developing the concepts and before you go into FID. Julie?
Tim, Julie?
Thank you both. And thanks again. I'll chime in my thanks to the petroleum economists for having us here today. Looking forward to the discussion with everyone. And, maybe in addition to the points that Jason and Tim have made kind of on the commercial side and thinking about it from an EPC perspective, and they've both gone a little bit further back in time, maybe if we look at it a little bit more near term, in that year or so immediately prior to COVID, I think, if we were looking at the projects that declared FID during that period of time, or if we're trying to think about the future and what projects or whether there will be projects that declare FID, I think we have to look at the whole project and the whole value chain because certainly what we've seen is that projects that have access to capital and then also access to supply or offtake were more likely to declare FID during that period. And frankly, without either of those, a project would not be able to go forward. We've seen a number of projects that were anticipated to be part of the second wave of US LNG projects that have gotten stalled as a result of one or more of those factors. And I think not necessarily directly tied to COVID. I think some of the supply issues that we've seen and some of the access to capital issues that we've seen were not necessarily tied specifically to the pandemic. And, you know, related to that, I think, is the access to demand centers. So we've seen some new and evolving demand centers outside of the typical markets for US LNG. And we've also seen some of the demand centers that we would typically consider to be markets for US LNG that have evidenced very recently that they may not be viable markets for US LNG. But clearly, the access to demand centers that are viable will be critical to the development of new projects. And perhaps, as Jason touched on a little bit, and I suspect we'll talk about some more, we might need to reevaluate the US LNG pricing model to be a bit more competitive in a low-cost gas environment globally. And then, of course, projects also have to give serious consideration to the facility side and some of the things that Tim has talked about in terms of the scalability, the modularity, the size of the facility, and frankly, what's practical and achievable and can get you to FID in this environment.
Thank you, Julie. Now this brings us into our second topic on new risks and commercial challenges. What are new risks and commercial challenges that LNG developers, financiers, and buyers are now experiencing as a result of the COVID-19 pandemic? Do contractors need to change to improve optimization and adapt to challenges? And if so,
Good thing
I might just lead this up. I'll lead this up. This is Tim. I think maybe Caryn just froze for a moment there. I think she was about done with the question, but I think we're going to start a new segment discussion kind of on what are some of the new methods that the LNG developers can consider when they take the approach to FID. So I'll probably, I'll just lead it off. I could start again with my build the asset hat on a second. You know, has COVID impacted that? You know, I think it's just extenuated issues that I may have mentioned before that are already in place. And it just become now more exposed with the pandemic issues and the tightening of business models around the globe for large capital projects and especially LNG projects. So let me suggest some of the opportunities going forward that if I had my developer hat on, I would be considering, and possibly my builder hat on would be asking for. You know, certainly the challenge to the builders is the lump sum contracting model is needed for surety. I appreciate that with regard to financing and requirements for cash at the beginning. But the EPCs, you know, also struggle and they choose not to be banks. So cash flow and viability of fair contracting terms is something that they're stressing more now, possibly than even a year ago when some of those projects were out to bid. So I suggest some of the new approaches to hopefully improving predictability and competitiveness as one develops an asset or thinks about how to develop an asset. And I think some of it's in the soft side, you know, establish the relationships that you need in advance with your contracting community and possibly look at ways to, you know, I'll call them arranged marriages, put together groups that have the right technology, the right availability of resources, and possibly the right skill sets together well before FID and try to come up with a good grouping. You know, some of the EPCs, and there's probably just one or two, you know, actually offer equity stake in some of these projects as a way to participate and possibly lower the initial cost outlay. And so maybe there's an opportunity for financing through the EPCs. You know, aggregating risk, I think, through some of more innovative contract terms, and sometimes they're viewed as integrated contracts that might include the owner and the EPC parties that are all party to one JV, maybe another way to mitigate and share risk a bit more equitably and eliminate the surprises at the end. It was mentioned in the outset, so maybe smaller many multiple train units to provide flexibility might be the right answer as far as how to arrange the asset. And not only does it possibly open up the contracting strategy to more participants, but it may allow more flexibility in the way you operate the facility as demand changes. So it is more of an asset efficient model versus what we may have seen in the past decades, what I call economies of scale, a couple large trains. And then modularization, that's been mentioned in many of the capital build scenarios. You know, let's disperse how we build these things in different locations, exposure risk, and certainly try to take advantage of some schedule, positive schedule advantages by splitting the work between multiple locations. But I see the bottom line, you know, let's reduce complexity in the asset configuration, how we approach contracting, and allow more construction and suppliers into the game.
Thanks, Tim. I think I was cut off halfway through the question, so I apologize for that, but it answered the question, which was great. Julie, would you like to add on to anything here?
Sure. I guess I can take it from a legal perspective. And 2020 has been quite an exciting year for all of us, I think. But, you know, lawyers in particular appreciate a little bit of volatility here and there. And I think if we look at what has happened during 2020 in the industry, COVID really created both challenges and opportunities, depending on your position in the market. And if we go all the way back to March, you know, we saw an initial influx of force majeure claims that really put the industry standard force majeure provisions to the test. And they seem to have largely served their purpose. They allowed relief from contractual obligations in circumstances where a party was genuinely prevented from performing, but not in the event of a so-called price majeure. Given that most LNG SPAs specifically exclude pricing or other market economic factors from force majeure relief. Then after that initial wave of force majeure claims, we saw the terms of cargo cancellation provisions really get tested as the demand downturn continued past the initial shock of March, April timeframe. Those provisions are obviously pretty much a mainstay in US LNG SPAs. They're intended to provide flexibility to the parties. They work particularly well in the United States because we are dealing with gas-on-gas pricing. We have the flexibility of a really robust natural gas market in the United States, and we have the ability to really adjust gas deliveries to these facilities and adjust the liquefaction rates in order to account for commercial and market factors. Some parties during this period will undoubtedly have tried to use these events to effectively renegotiate the terms of their SPAs, whether that's on a short-term or a long-term basis. You know, if a seller or a terminal operator is faced with the potential that a buyer or a customer might look to terminate a long-term contract, I would suspect that many would have looked to settle those potential differences of opinion and different commercial circumstances in lieu of agreeing to a termination or getting locked into a long-term dispute. So it's to be seen whether some of that is on a long-term basis, or whether we're really and truly just dealing with short-term issues to address the current market circumstances. As we all know, most LNG SPAs are based on a Henry Hub or other index-based pricing, gas-on-gas pricing. And so, you know, one of the items that has been tested during this period is many of those contracts may not necessarily have price reviews or price reopener clauses. And so the parties have had to potentially get a little bit creative about how they address some of those issues that have arisen during 2020. As I mentioned earlier, there have also been some challenges for projects looking to take FID in terms of securing creditworthy offtake sufficient to support those projects, and the financing and the capital requirements associated with developing those projects. And it would be reasonable to expect that those challenges would continue, at least in the short term, as the industry recovers from a global oversupply situation. One way in which potential buyers of US LNG could address this risk is by seeking shorter term contracts. That was certainly happening in the United States to some degree, even pre-2020. And shorter term contracts may aid in diminishing the near term oversupply of US LNG. But frankly, if we're looking at it from a mitigation perspective, the biggest benefit would be to those projects that are already in operation with surplus LNG to sell. And it may not do much to help projects that are seeking financing or looking to take FID. Because frankly, to date in the US LNG industry, we've operated on the basis of long-term contracts for the most part, particularly for those projects that have been project financed. And so there's an open question that will be discussed during the conference today about how lenders will really address financing such a massive capital investment and undertaking on the basis of shorter term contracts. There's certainly precedent for that in other sectors of the industry. And so it remains to be seen whether we can get there in the LNG industry. One structure that we've seen specifically in LNG to power projects to address some of the commodity risk and the financing risk is for LNG suppliers to take equity in the projects in which they will be supplying. And this helps to provide some capital to the project while at the same time potentially acting as a form of insurance against project co-risk by giving the supplier a voice in the governance and decisions that are being made by the project equity. And one final point that's worth mentioning, I think, as a challenge to projects looking to take FID in the current market is the increasing demand for green LNG, which could potentially decrease the available markets for US LNG and create continued challenges for projects that are looking to secure firm offtake or capacity contracts, just because it may limit the destination markets, or it may require some form of crediting or addressing the greenhouse gas emissions related to the production of US gas from unconventional resources. But this also creates opportunities for projects to develop new means of greening US LNG. Thanks, Caryn.
Thanks, Julie. Jason, what's your perspective on some of the new risks and commercial challenges?
You know, it's funny because I mean, LNG was you know, sort of before, I don't know, 10 years ago. Really the only risk was sort of project development, you know, sort of project execution, because you had this sort of stranded gas, you had this valueless asset, and then you sort of signed long-term contracts that backstop project finance. The off-takers weren't particularly price sensitive because they were usually selling into regulated power and gas markets. So cost was just passed down. So it was a lovely thing because you found this worthless asset and turned it into, you know, this 20, 30, 40 year asset, you know, that produced 10, 12, 13% returns. So it was a wonderful thing. There was almost no commercial risk, market risk to anybody. And you know, what's happened over the past 5, 10 years is that that model has just sort of changed, you know, very significantly. So I mean, pretty much everybody used to price on Brent, but you know, now pretty much all the U.S. Contracts are priced on Henry Hub, but you're selling that gas into Brent markets or into JKM or into Europe, TTF. So you've got this enormous amount of basis risk. And a lot of US lifters don't know where they're going to sell the volume. So, you know, they're trying to figure out, am I going to sell it to Asia 2 months from now? That what does the JKM curve look like? So you've introduced this enormous amount of market risk. And I think one of the problems is that you've had this tremendous amount of change, but you haven't had the markets sort of keep pace. So you can hedge JKM reasonably well. You can hedge TTF. But there aren't sort of really spread swap markets yet. The only real sort of derivative, over-the-counter derivative, not bespoke derivative is just the JKM swap. And then you're selling into gas pipeline networks. So you're pricing off the US gas pipeline, you're selling into an LNG marker in Asia, selling into pipeline prices in Europe. And so the markets haven't developed the same way you see in other more commoditized markets where, you know, it's fairly easy to hedge your crude oil price risk, pretty easy to hedge your electricity risk, things like that. Those are liquid, well understood markets, and LNG is sort of still finding its way through that. And so, you know, rather you've gone from a fairly simple market to a really complex market without a lot of the tools that you would normally have to sort of manage that complexity. So I think that's a big one. And I think one of the other ones is just that, you know, off-takers, now they're rarely selling into regulated markets. They can't pass through the costs anymore. And they're concerned about, I think Julie mentioned, you know, the greening of LNG. People are worried about what the risk of, you know, carbon mitigation measures, legislation, carbon markets, how that's going to affect. So you used to have off-takers happy to sign, you know, 20-year agreements. They wanted long-term agreements because they were concerned about security of supply. And now you have off-takers, you know, they're happy signing a 5-year contract because that seemed 5-10 years, you know, they don't know what the market's going to look like then. So you just have this sort of sea change. And, you know, a lot of the sort of techniques that you would use to mitigate the change and to sort of manage that change haven't been developed yet. And then you still have a big chunk of the market, 60% of the market, 70% of the market being sold on a Brent basis or being bought on a Brent basis. So you have this sort of wave of contract expirations that are going to change everything over the next, you know, 5 to 10 years. So we know the change is coming, but it's kind of hard to sort of manage it as this sort of wave of change rolls through the industry. So I think those are some of the real issues.
Wonderful. Thanks, Jason, and thanks to Julie and Tim. So let's go to our third topic on commercial and operational disputes. Julie, generally, what are some of the commercial and operational disputes that we are now seeing, and where do we go from here? I know you touched up briefly on the long-term versus short-term contract structure, but do you believe that considerations are being made to restructure the long-term contracts as an attempt to minimize this? Are shorter-term contracts being considered to improve cost recovery? What are your thoughts?
Thanks, Caryn. A lot of great questions there. I'll start with the disputes point, I guess. And while I certainly couldn't speak to any specific dispute, you know, I think in addition to what I've outlined and what we've discussed previously here on the panel about contractual impacts that have resulted from COVID, general supply and demand dynamics and the evolution of the LNG industry, I think we could safely say that the events of 2020 were particularly ill-timed for some US LNG projects that had only recently achieved commercial operations. And really, if we looked at it holistically, we're not just thinking about the impact of COVID. We're not just thinking about the you know, supply and demand dynamics. We're also thinking about major hurricanes and a very active disasters. And so it's really the combination of a lot of different factors all coming to a head in 2020. The general uncertainty, which Tim has already spoken to in terms of putting a massive liquefaction facility into service, has been compounded by fluctuations in the use of those facilities that, frankly, the use has perhaps differed a bit from what was anticipated, certainly when the contracts were entered into, but even more recently, you know, while folks may have envisioned a number of cargo cancellations, certainly the degree to which the US market has seen cargo cancellations in 2020 is not what was anticipated as we headed into the year. And as many of you probably know, most US LNG projects are based on a tolling model. And under a tolling model, the operator is the operator and is separate from the commodity and any associated commodity risk. And the customer contracts for a certain amount of capacity on a reservation charge basis, meaning they pay for that capacity whether they use it or not. So except for certain limitations that would be set forth in the contracts that would be specifically tied to operational considerations, the operators in the project codes have limited control over how much gas actually gets delivered, which gives the customers significant ability to modify their gas deliveries to accommodate cargo cancellations that may be dictated in turn by economic factors or customer demands. And as I think we've seen this year, that can create operational difficulties for projects that have only recently commenced commercial operations and could potentially, in theory, at some point in the future, result in the disputes between the customer and the project company, or the buyer and the seller on the commodity side, as a result of either the operational issues or the commercial issues. In terms of thinking about what to do differently in contracts, there are some proactive steps that counterparties are taking in contracts. And that includes things like strengthening or restructuring force majeure provisions, or at the very least, paying specific attention to force majeure provisions. I think there probably won't be many parties right now that enter into force majeure provisions that don't specifically address pandemics and epidemics. That would include price review and price reopener provisions to the extent that they exist, refining the cargo cancellation provisions and the remedies for cargo cancellations, and maybe addressing some of the operational issues that we've seen result tied to cargo cancellations. And potentially, as we've talked about a little bit already, and Jason may elaborate on this a little bit further, reconsidering pricing structures in their entirety. With respect to shorter term contracts, we're certainly seeing a trend in that direction, but as I think I've mentioned previously, that trend started well before 2020, well before COVID. There was a move toward shorter term contracts, at the very least as part of the development of a secondary market for US LNG. And during COVID, it's obviously developing as a potential option for addressing cargo cancellations as a result of the oversupply and the decreased demand in the industry right now, as well as a potential option for projects that are still looking to take FID or secure some firm offtake and hopefully the associated project financing that would go with that. So that may trigger the lending community or financiers to start thinking about how to finance a project on the basis of short-term contracts, if that's really what's available in the market right now.
One of the things that I think is really interesting about these disputes was that, you know, LNG, not the most flexible market, because that's just not the structure of the market. You know, long-term contracts priced against oil, ratable, take or pay. You know, it was set up for, you know, to run these plants at maximum, you know, capacity, the most you could, use your ships as efficiently as possible. And then you had this, huge sort of curveball thrown at the market, in the form of COVID, where you saw these huge declines in demand initially. I mean, it's mostly come back, but, massive disruption to the market. And the fact that it functioned as well as it did, the US, I mean, Julie made the point that the US nobody thought the US would reduce output by 70%. Once these plants were up and running, everybody kind of assumed the cancellations would be occasional and, specific to individual companies. And it was this, headlong rush, 200 cargoes canceled about. But the market actually handled that. And you had this huge number of force majeure attempts, none of which were accepted by the sellers. And, everybody, I mean, I guess it's going to keep Julie busy for, years, sort of sorting through that. But again, everybody sort of declared force majeure. The sellers said, no, we don't accept that. And then everybody got down to business. And, 40, 50 cargoes in Japan and Korea and in other countries were just kind of deferred into the third and fourth quarter. So, I mean, for a market that was very, not very flexible in its basic structure and not used to this kind of disruption, the market actually sort of managed to muddle through it in reasonably good shape. I mean, like I said, been a blessing for attorneys and people and, some other in arbitration and consultants like Poten, but I mean, the fact that we managed to get through this huge disruption in relatively good shape, I think is quite interesting, sort of a sign that things are in fact changing. I think 10, 15 years ago, something as disruptive to the global market as this would have been really crippling. And it hasn't been this time around.
It's such a great point, Jason. And I wish as a lawyer that I could totally take credit for all of that flexibility. But I do think that your point is absolutely valid in the sense that this shift away from, point-to-point contracts, the development of swap and substitution and arbitrage opportunities, and all of these things that has occurred in the LNG market over the course of the last 10 plus years, plus the introduction of a large amount of US LNG, which is different geographically, it's different in terms of pricing, it's different in terms of the governing law of the contracts even, that really introduced more of a diversification in the industry that I think you very rightfully point out has helped to mitigate the impact. We were already on that path toward more flexible contracts and building that into the agreements. And without that, it potentially could have been devastating. So I think that is a benefit, and I think it will be something that everyone keeps in mind as we continue to move along this trajectory of increasing flexibility, in shorter term contracts, more trading activity, more of those general commodity-like behaviors that we would expect to see.
Mm-hmm. Yeah, I agree.
I think I'm frozen up. I hope you can hear me.
There we go.
Okay. My internet. Sorry, everyone. But we only have 3 minutes left, and let's go to the last topic on improving commoditization. So if there is a third wave of LNG projects going to FID, what strategies project developers and buyers to improve commoditization? Jason, can you?
Yeah, I'll try to use 1 minute. A few things. I mean, I think one is the industry sort of has to rally around, there has to be consensus around pricing. The fact that we price on crude, on LNG, and on pipeline prices in the United States and Europe is a real problem. That makes it very difficult to manage risk. So what you would expect to see is more of a consensus around a couple of prices, whether that's, JKM and a European marker or an American marker, I don't know. But that's something that really needs to happen. This sort of large number of unrelated prices, pricing LNG creates all kinds of risk. And that's what you'd expect to see in a commoditized market. I think, you know, smaller, shorter contracts, you know, and again, that's how crude works. That's how most of the other commodity markets work, is you have a larger number of deals. So, you know, you're not locked in for 20 years and all of the anxiety. Price reviews, the idea of sort of a price review in a crude contract, just, you know, you just price off of Oman, Dubai, or Brent, or whatever the crude marker is. So I think, you know, in terms of commoditization, that sort of consensus around pricing that would allow of indexation, that would allow the development of much more effective risk management, I think is a real key thing that's lacking right now.
Okay, thanks, Jason. And Tim, real quick, what's your input?
Yeah, maybe just quickly, the third wave, you know, so the third wave may be, and you know, again, from the asset standpoint, just a reconfiguration of the second wave that didn't make it. So I think, you know, those reconfigurations certainly going to have to address, you know, how to get quicker to the market with more reliability and performance of the asset, and possibly more innovation in the way the asset is configured or phased. So maybe, for example, there's longer phase deployment of assets, the plug and play configuration concept. We talked about modular assets, but possibly those that can be redeployed to other locations. Floating assets fits into that, but so far as we've seen, bigger is not better as it goes with those sort of LNG production facilities. But, you know, let's hope that maybe there's technology and innovation that can assist here in bringing the cost of capital down.
Thanks, Tim. And Julie, we're at the end here, but I know you probably want to just add a little bit here as well.
I'll just close with a very quick statement against interest and note that I think the continued movement towards standard contract terms is a natural next step in the commoditization of the industry. We've seen it time and time again that when industries move toward more transactions or shorter term transactions, they've got to be completed more quickly and on the basis of terms that are well known to industry participants. You can think about the NASB, you can think about the ISDA or certain PPAs to see how well-developed commodity sectors contract, particularly on a short-term basis. And I would certainly expect to see that as part of the transition as the industry moves forward and brings more short-term contracts into the contracting mix.
Excellent. Well, thanks, Julie, Jason, and Tim for providing such valuable insight during today's session. Thanks to our participants. We know your time is very valuable. And thanks again to the Petroleum Economist for hosting such a fantastic event. Stay well and be safe, everyone. Thanks again.